Okay, you're good to go.
Right.
Oh, oh wait, no. I just realized. There. There you go. So anything you need, just promise.
Okay, very good. Thank you. All right, good evening, everyone. Thank you for coming to listen to me tell you something. I'm not sure exactly what, but I'm here to mostly answer any questions that you have and give you some tips. Georgia could actually conduct this little seminar since she took my class last spring semester. So it'll be redundant for her, but maybe the first time the rest of you have heard these kinds of things. My name's Greg Hoffman. I am retired, but I spent 31 years as an investment advisor and managed about $130 million of other people's money. And that's a little stressful, especially in times like we're going through right now. Have you all, I assume you're all investment folks, so you've been paying attention to the market and you know how unpleasant it's been. Today was a pretty nice day, but we're down on the Dow Jones Industrial Average about 22% year to date and about 34% on the NASDAQ, which is made up of mostly technology stocks. Technology stocks have taken a lot of the hit so far this year. But Georgia said that you were interested in learning about the difference between Roth IRAs and traditional IRAs and other retirement type savings accounts and the benefits of the different types. And stop me at any time that you have a question or I use some sort of nomenclature that doesn't make any sense because it's just from our world. There are basically two types of retirement accounts. There's what is called traditional IRA. Yeah. One of these has some ink in it.
I'll go see my coach's office is open. So he usually brings something.
Okay, yeah. I used to bring my own, but I don't think I have one here any longer.
This one kind of works.
Yeah.
The green one, not the black. Yeah, see if that one works. Oh, here's another one.
All right, great.
Yeah.
Thank you. Two types, traditional IRA and Roth IRA. They're both retirement accounts. Both can be started with as little as $25 and added to a little bit at a time, over time. What's the one thing you have control over, Georgia?
Time.
Time. You have no control over the market. You have no control over interest rates. You have no control over McDonald's profitability, although some of you may help their profitability from time to time by frequenting their stores. But you do have control of time. And I'm so happy that you're interested in this topic at your age, because the sooner you start, the smaller amount you have to put into a retirement account to be able to retire at a future point in time, because you have time working for you. So a traditional IRA is what most people have or what most people are familiar with. The benefits of a traditional IRA are that you can put up to $6,000 in per year and deduct that from your income. So it reduces your taxable income. So for example, if you make $100,000 a year, you put $6,000 into your traditional IRA, your taxes are going to be based on $94,000. So you get an upfront deduction and an immediate benefit from a traditional IRA. The disadvantage is you can't touch that money until you're 59 and a half years of age, or else you will incur a 10% penalty. So there's a penalty for early withdrawal. So when you put money into a traditional IRA, you can take it out, but it's going to be taxed and it's going to be subject to a 10% penalty. So you have to think about retirement assets as being out of reach. They're not available unless it's an absolute critical emergency. Okay. And then there are some waivers that you can possibly avoid the 10% penalty. But think about it as being out of reach, unavailable, break glass in case of emergency. That's the only time. So the Roth IRA, on the other hand, hello, let me get it. So a few years ago, Congress came up with the idea of a Roth IRA. The Roth IRA has no immediate tax benefit. You don't get to deduct what you put in it from your taxable income. It grows, though, tax-free. The traditional IRA, you're just delaying the taxes. So if you put $6,000 a year away for 30 years, you invested $180,000. Hopefully that $180,000 has grown to $2 million. As you start taking that $2 million out, you're going to have to claim that as income and pay taxes on it. So with the traditional IRA, you get an immediate tax benefit, but you pay the taxes later. So somewhere, somehow, the government's going to get their share of the money. Okay. So a couple of important numbers. If you take it out before you're 59 and a half years of age, you're subject to that 10% penalty. At the age of 72, you have to start taking some money out. There's a calculation based on your life expectancy. So at 72, your life expectancy, according to the tables, somewhere around 78, 81 years of age, you should die. Okay, they want you to get that money out of there and pay taxes on it at some point. You can leave it to your beneficiaries. You can leave it to your spouse or your children or me, if you so desire. And I'll pay the taxes, okay? I'll gladly pay the taxes instead of you. But at 72, you have to start taking some money out. With the Roth IRA, the money you put in is taxed. So if you make $100,000 and you put $6,000 in your Roth, you're going to pay taxes in that year on the full $100,000. The advantage of the Roth is that the growth is tax-free. So if we put that $6,000 in for 30 years and we've invested $180,000 and it's now worth $2 million, when we start taking that money out, we don't have to claim it as income. We don't have to pay taxes on it. So there's a real benefit to that. The Roth IRA works best for younger people. The longer you have, the more time for that money to grow tax-free. Somebody my age, it wouldn't make a lot of sense. I'm contemplating converting some of my traditional IRA into a Roth, so my kids won't have to pay taxes on the money. I'll pay taxes on it during my lifetime, but it'll still be in a tax-free growth situation. So you can convert a traditional to a Roth. You can't convert a Roth to a traditional. Okay. Tax deferral is a huge thing because let's say that this is totally fictional. In the year 2022, our portfolio grows by 10%. And let's say I'm in the 25% tax bracket. How much is my return being reduced by? How much?
35%.
25. I'm in the 25% tax bracket. So I'm going to reduce my return by 25% or 2.5. So my net return is 7.5% after tax, if I have to pay taxes on my growth. But if I'm able to be in a tax deferred or tax-free account, I have zero tax liability for that year, and I get a full 10% return on my money. And I pick on Georgia a lot. Have you all heard of the rule of 72? Well, you just did. Write this down, take this note. The rule of 72. What is the rule of 72, Georgia?
It's the amount of time it takes your money to double.
Yeah, you divide the rate of return that you're getting into 72, and that will tell you how long it will take for your money to double. So if I'm earning 10% on my money, if my rate of return is 10%, how long is it going to take my money to double? Divide 72 by 10. How long is it going to take for my money to double?
2 years.
How many? Exactly. 7.2 years. So at 10%, my money doubles every 7.2 years. If I'm earning 7% on my money, how long is it going to take for it to double? How many? It'll take 10.2 years. So divide 72 by 10 or by 7, and you get 10. So at 15% rate of return, your money's going to double in about 4.5 years. So you can see, and think about that. If I'm doubling my money every 5 years, I have $6,000 that I put into my retirement account. In 7 years, I've got $12,000. 12 more years, I've got $24,000, $48,000, $96,000. As you can see, the longer you have in time, the more doublings you get. So when you get to the point where your 196 is now what, 392,000, another doubling, we're just shy of 1 million. So the rule of 72, yes.
Question. So on the Roth IRA, whenever you put money in, so you're only paying taxes on the 6,000, not the gross. So say that you put in 6,000, the next 7 years happens and it's at 12,000, but you only put say 2,000 in that year. You're only paying taxes on the 2,000, not 12,000, right?
Correct.
Okay.
Yeah. Yeah. The beauty of the Roth is the growth is tax-free. You've already paid taxes on the money that you're putting in, but that increase in value is not going to be taxable in the future. So that's the big advantage.
Is the increase on just the principal you initially inserted, or is it like the principal plus the amount of portfolio, like amount of growth it has, double that?
Yeah, the return would include the previous year's growth. So you're getting compound. Is basically what you're getting. You're getting your $6,000. If it grows 10%, that's going to be $600. So if the next year it grows by 10%, that's going to be another $660, assuming you didn't make any additional contributions. So yes, you get compounding on the money. Now, I would love to tell you that yes.
Oh, I was just gonna ask, is it common for people to transition traditional IRAs into Roth IRAs so they get the benefits of Roth IRAs? Like, do they say that a lot?
It's a case-by-case basis on what a person's trying to accomplish, what their tax bracket is, what their earnings are. Clients that typically, a young client, I would advise to fund Roth IRAs as early as possible. One more advantage before I forget to mention it. unlike the traditional IRA, when you put your $6,000 in there, it's not touchable until you're 59 and a half. If you put $6,000 in a Roth IRA, you can withdraw that $6,000 and use it and have no penalty or taxes. If you leave the earnings and the growth in there, it's still tax-free. But if you take out more than your principal, then you'd be subject to a penalty. So the reason I really recommend young people start Roth IRAs, not only the time and the tax-free growth, but if you need to, you can take money back out of your Roth IRA and not have a penalty or taxes because you're just withdrawing money that you've already paid taxes on. Okay, is that clear? Did I confuse you completely?
Do you suggest Roth IRA as early as possible for younger people? Do you suggest having both, or would you just suggest only having Roth IRA?
You're limited to, you can do a combination of both. You can have both a traditional and a Roth, but you're limited to the $6,000 maximum contribution. So you could put 3 in one and 3 in the other, 2 in one, 4 in the other, but you're limited to the total amount you can put in.
So what is the difference in like advantages and disadvantages of having a Roth IRA compared to like a 401k?
Okay, very good. I'm just going to get to that. These are the two basic types of retirement plans, traditional and Roth. In the corporate world, you have what is called a 401k, where you can have money deducted from your paycheck each pay period and go into your retirement account. 401ks can either be traditional or Roth. So you can have both. Am I messing up your zooming?
No, I'm just making sure that we can see the
I think
board.
it's better if it's just the audio and no visual, frankly. They got it. Nobody's going to want to look at me is what I'm trying to say. So a 401k can be traditional or Roth. And again, you can make the decision based on your financial circumstances, which one is going to make better sense for you. And the plug for the industry, that's what financial advisors are for, to sit down with you, review your financial situation, review your goals, review your timeline, and help you decide what the best option is going to be for you. So 401ks are retirement plans in for-profit companies like Walmart, 3M, McDonald's, Microsoft. These are all companies that are trying to make a profit. And so employees in those companies can put money into a 401k. One of the advantages to a corporate plan is you're not limited to $6,000 a year. And I can't remember what the dollar amount is that you can contribute, but it's about $15,000, I think, for 2022. So you can put a lot more money into a corporate plan, like a 401k, than you can in an individual IRA. Depending on your income, you could maybe do both. You could have a 401k and an individual retirement account. Yes.
Question. I know that there are companies that like maybe match the money that you put into a retirement plan.
Mhm.
So is that 15,000 that you can have for a year? Is that including what you're putting in, or including your company and yourself?
No, it does not include the company match. That's just reduction in your wages.
Okay.
So, and you brought up an extremely valuable point. When you do get out into the world of work, the first thing I want you to do, and I'm going to haunt you if you don't do it, is sign up for the company retirement plan and take advantage of at least the matching amount. If the company matches 4%, you better put in at least 4%, because that's free money. That's a 4% pay raise that you don't have to do anything to get. So, yes.
I thought companies only matched up to $600. Is that standard, or is it vary by company? Like
It varies by,
$600 a month.
it varies by company. Yeah. Usually it's a percentage of wages. And the most common number that I've seen is 4%. But companies can do whatever they want. one of the, well, 401ks became popular in the 1980s. Prior to that, what did companies do? What did they have for retirement for their employees? A pension. Yeah. Yeah, back in the dark ages, if you worked for a company for 30 years, they put all of the money into your retirement plans. You didn't have to put anything into it. And when you reached a certain age or a certain milestone or met certain requirements for the company, you were guaranteed a check in your mailbox for the rest of your life. Well, companies figured out that was expensive and it hurt their profitability. And so they did away with pensions. There are very few pensions left. Teachers still have pensions. There are still some employers that offer pension plans, but they're extremely rare today. All of the burden is put on the employee to save enough money for their own retirement. Yes.
Would you recommend having a 401k and a Roth IRA, or doing like one or the other?
Again, you would be limited by the total amount. Yeah, if you can afford to do it, I recommend maxing out everything you can, but you probably also need money to live on.
Yeah.
So, and I'm going to show you some illustrations of why it's so important to start early. And let me get back to this. 401ks are in the for-profit sector. If you are a professor here at Cottey, you can contribute to a 403b. This is a retirement plan similar to a 401k, but for nonprofit institutions like schools. That's one of the primary examples of or if you work for a nonprofit organization, they also have 403bs. And then there's one last one called a 457 plan. These are retirement plans for governmental institutions. Like if you work for the city of Nevada or the county, Vernon County, you can put money into a 457 plan. They work pretty much the same. There are Roth options and traditional options on all three. They all have the same tax benefits. There are different contribution limits for each of the three, but starting out, I'm not too worried about you maxing out what you put into your retirement plan, because when you first start working, you're going to have things like a car payment and furniture and rent and other stuff. And somewhere along the line, you're going to buy food and groceries. So you can't put everything into your retirement plan. So for-profit contributes to a 401k. Nonprofit, 403b. Governmental entity, 457. And they can all be traditional or Roth. I'm going to bring up financial calculators and show you why it's so important to start early.
I can raise that back up. That would.
Oh, I can do it here.
Got it.
Okay. All right. Okay. I'm gonna start.
I'm gonna share the Zoom screen real quick.
Where's everybody from?
Minnesota.
Minnesota. Very good.
Carthage.
Well, you're a long way from home. Did you go back for the celebration this last
Yeah.
weekend?
My
Yeah.
sister was big week.
She was.
Yeah.
Congrats. We have a celebrity in our midst. Where are you from?
Ecuador.
Okay, welcome.
Florida.
That's almost another country.
Wisconsin.
Okay,
Oregon.
okay.
Arkansas.
Arkansas.
Mhm.
Okay,
Ohio.
okay,
Ethiopia.
okay,
Kansas.
okay. That's another country too.
Oklahoma.
Okay,
I'm sorry.
okay. Very good. Got a nice geographic mix. That's great. Okay. I'm going to put in here that you start saving for retirement at 25. I'm going to give you a little bit of time after you graduate to enjoy making some money. And full retirement age, 67. This may not be, and I'm going to say that you're making 50,000 a year, and our savings rate is 8%. So, this isn't the calculator I wanted. So everybody ready for it to get really cold tonight?
It's already cold. I was walking over here from the library and my thingies was freezing.
Yeah, well, you've been spoiled. It's been so nice for so long that it's going to catch up with us.
Yeah, just later in the week, they'll pop back up to 80.
Yeah, next week it's going to be back in the 80s again.
I'm sorry. Prepared to get sick if temperature changes.
Yeah.
Well, the old saying in Missouri is if you don't like the weather, wait 5 minutes, it'll change. And that's true.
You ever been to South Dakota?
I have. I've also been to Minnesota.
Yeah, for refuge.
Yeah. Yeah. If I'm ever homeless, don't look for me in Minot, North Dakota, or International Falls, Minnesota. That's not where you'll find me. It's going to be in San Diego. You know what they say about Minnesota?
Tell me.
What do people in Minnesota do in the summer?
Go to the lakes.
If it falls on a Sunday, they have a picnic.
Okay.
1 day a year of summer. The other 364 are winter.
Yeah, sounds about right.
I didn't get it. I
It's
got it.
usually,
I got it now.
Okay. Why am I not finding what I want? This is just frustrating. All right. Initial deposit, 10,000. I'm going to make this 6,000 just for our IRA purposes. And so that's your first year, and then we're going to take $500 a month. 500 times 12 is 6,000, isn't it?
Yes.
And we're going to do this over a period of years. Let's do 40 years. And let's average our rate of return at 8%. Okay. Yeah. And 1 million ain't what it used to be. we've talked in class about inflation.
Mhm.
Little did I know it would be such a headline topic today. But inflation is when things are more expensive today than they were yesterday. And inflation is definitely an issue. So this is $6,000 a year over 40 years. We come up with $1.7 million. So we've invested how much? 6,000 times 40 is $240,000.
Yeah.
We've put 240,000 of our own money in here, and it's now worth 1.7 million. Not bad, not bad at all. What happens if we wait 5 years and we don't start doing this until we're 30 instead of at 25? How much did it cost us to wait 5 years?
Like $600,000.
$600,000. How much did we not invest during that 5-year period? 5 years at $6,000 a year, $30,000. Not saving $30,000 cost us $600,000. This is why I'm telling you to start as soon as possible, because waiting 5 years is expensive. So even if you can't afford to put the full $6,000 in, put something into your retirement plan. Okay. Now, what happens if we change our rate of return? And the stock market over the last 70 years has averaged north of 10%. This year, it's not going to do that, but on average, it's averaged 10% per year. So if we increase that, and this is just for the 35 years, not the 40 years, we get a 10% rate of return. We started at age 30. We've got 1.8 million. Look at what happens if I take this back to 40 years. $3 million. By increasing the rate of return by 2%, and by starting at age 25 and doing this for 40 years, $3 million. I'm here to tell you, by the time you all retire, you're going to need $3 million to sustain the standard of living that you have today, or that you are used to today. Because inflation is going to cause $3 million to be worth not 3 million in today's dollars. So, and
I have a question.
yes.
So that note there says that the average is 0.06.
I think that's for a bank account.
Yeah.
Like
Mhm.
not like a,
Not an investment account.
Okay.
Yeah.
Thank you.
Yeah, this would be just in a savings account or a money market type account. And that's based on current, and this probably hasn't been updated for a while. Interest rates have doubled in the last year. The 10-year treasury was at 1.7 and it's now at 4.1, I think. So yeah, I appreciate you seeing that little footnote, but doesn't apply.
I have a question.
Yes.
So as an international student, if I don't end up staying in America, like this doesn't really benefit me much. Or if I had asked the question in one of my classes, so do you recommend opening an IRA account if I'm going to be leaving?
Check and see what investment options are available where you end up. But you can invest internationally in the same kinds of investments. The tax situation, the tax benefits of the traditional and a Roth are going to be different country to country. So you'll just have to check and see what they have available. I'm not familiar with other countries.
How about like the stocks option? Do you think it's better? I'm not going to be investing in a traditional like IRA or the Roth.
Yeah, you can have just a non-retirement account that doesn't have any current tax benefits, and every year there may be taxes due on dividends that are paid out by companies. And if there are any profits that are realized, like you sell, you bought Microsoft at 100 and you sold it at 200, you'll have to pay taxes on the profit. So in a non-retirement account, there will be some tax consequences, but you can do that, and you can do that in any country. So the non-retirement account, it'll just be based on whatever the tax laws are in the country that you're filing a tax return in. Mhm. Yes.
So if you're looking at like the circumstances of the scale of the economy and you know that inflation is going to continue to rise, would you suggest investing as much as you can then so that you can meet like the expectations of standards of living before you retire? Or how does that work?
Well, inflation is cyclical. We haven't seen inflation like this since 1980.
Right.
So it's been 40 years. Most people aren't familiar with how to deal with current inflation like this. And what worked 40 years ago to squelch inflation may not work today. And that's raising interest rates. I graduated from college, I'm really old, in 1981. In 1981, the prime lending rate was 21.5%. Mortgages were 15%. You could buy a 30-year treasury bond and lock in 15% for 30 years. So every 5 years, your money would have doubled in a government guaranteed investment. But it was a crippling economy. We were in a deep, deep recession. That's how I ended up in Nevada. Companies weren't hiring. So I took a job teaching marketing and economics at the local tech school. And that was because I was broke and starving and a recent college graduate. And I taught for 6 years, and then I opened my investment practice. So you get this, the reason why you start early, time matters. And that's the only thing you have any control over. You can't control the rate of return. You can't really control how much money you can afford to save because it's going to be based on whatever your wages are from your employer and what your cost of living is. But you do have control over time. Okay. Other questions about retirement accounts? Yes.
So I know some companies, they don't offer you a 401k right off the bat. So is it possible to get your own?
Yeah, that's what the top two would be, just either an individual traditional IRA or an individual Roth that's not through the company. So yeah, you can go ahead and start your own, or if you're crazy enough to start your own business and you're not working for anybody, you can have your own retirement account. And like we said, you can have both if you can afford to do it. Have a traditional and participate at the 401k. Yes, other questions? Yes.
So do you have any company recommendations to
Individual stocks that I like, a hot tip that nobody else knows about?
yeah.
Yeah, no.
Stocks or companies for 401ks. Yeah.
Yeah. Ethically, it's not acceptable for me to give mass financial advice because your situation is going to be different than your situation. But there are a lot of good companies out there. You can go through a company like Vanguard or Fidelity, or American Funds is an excellent fund company.
I guess we have time on that rather than asking which one. How do you look up those kinds of policies so you can try to make those decisions before like committing to a company?
So
like, would it be somewhere like on their website, or would that be something that you ask during the hiring process, I guess?
it would be something you would ask at HR, what kind of benefits they offer. And the most critical benefit today is health insurance because it is so crazy expensive. So if a company provides health insurance, or at least provides a portion of your health insurance, that's a biggie. And just about all companies offer a 401k or a 403b, depending on what type of company they are. A question that you can ask, though, is what their match is, because that will vary from company to company. And the higher the match, the better. And the reason companies do that, pensions were attractive because they helped you retain employees over a long period of time. If you work here 5 years and then you transfer to someplace else, you're going to start all over on their pension plan. Today with 401ks, they're portable. If you work at this company for this many years and you decide to change companies, you can transfer your 401k to your new company. Or you can roll it out into an individual retirement account that's not connected to your company. And you can control how it's invested and what your investment options are and so forth. So just know that the two types are Roth and traditional, whether it's individual retirement account, corporate retirement account, nonprofit, whatever it may be. Yeah, excellent questions though. Other questions? Yes.
So you said that 6,000 was like the maximum that you could put into the IRA accounts. Is there like a minimum?
No, it depends on where you're opening the account, but there are places that you can start with as little as $25 and then add to it over time. And I think the maximum is 6,000. I've been retired for a few years, so I don't know exactly what the maximum is now, but I know it's at least 6,000. Yes.
So what's the difference between a brokerage account and these two, or is that the same?
A brokerage account is an investment account that allows you to invest in individual stocks like shares of 3M or Microsoft or Netflix. You can also invest in bonds. You can invest in government-backed securities. So a brokerage account is just the vehicle to help you invest.
Right. So like Vanguard, they offer brokerage accounts and like Fidelity.
Yeah.
But those are separate from traditional Vanguard.
No, inside Fidelity or Vanguard, you can have a brokerage account that would be a traditional IRA.
Oh,
okay. So Vanguard's the company, the type of accounts, traditional IRA, and then you decide what investments you want to put into that IRA. Okay. Clear as mud? Good. Other questions? These are great. Do any of you own stocks now or mutual funds now?
And stock track.
In stock track? Yeah.
We've been doing a simulation and been starting to like do investing.
Okay, cool. Very good. Yes.
what do you think about the foreign exchange market, like trading currencies instead of stocks?
It's an important part of investing because right now the dollar is at an extremely high mark relative to other currencies. So what that means is it's a really good time for US citizens to travel overseas because our money goes farther. But it's really expensive for somebody from another country to come to the US because their currency doesn't go as far. I think it's like $1.20 to equal the euro right now. So it's about 20% higher than the European currency. So it's a good time to buy a foreign car, good time to travel, bad time for if you've got family in Nigeria that you want to come visit you because their currency isn't as strong as ours right now. And that fluctuates. Trading currencies can be risky business though, because it can change very quickly. The best way to do that is through a mutual fund, or an ETF. So you don't have to deal with the currency conversion. If you buy a European-based ETF, you're buying it in American dollars, and they're converting it into European stocks, European investments. Yes.
Use it up.
Yeah, the best way, the simplest way, maybe not the best way, but the simplest way to deal with currency fluctuations is to buy ETFs, exchange traded funds, that invest in international non-US companies. Because you don't have to deal with the currency exchange. That happens at the mutual fund level. Mhm. Anything else? Are we good on retirement accounts? You want me to talk about ETFs now and exchange traded funds and mutual funds or index type funds? That was the other thing you had mentioned that you wanted to learn a little bit more about.
Yeah, if you can go over mutual funds, I kind of want to.
Okay. A mutual fund is an investment tool where you're pooling your money together with a lot of other investors that have the same goal as you. So if you're 25 and you're looking at 40 years before you need this money, you can afford to be fairly aggressive with your investments. But you don't want to have to do the research to check out the companies and understand their financials and guess what their profitability is going to be. Pooling your money together with a lot of other people and then hiring a team of professional money managers to make the decisions for you about whether it's a good time to buy Netflix or if it's a bad time to buy Apple. Because institutional money managers have access to information that you as a civilian will never get access to. If you call up the CEO of Netflix, they're not going to take your call. But if an institutional money manager calls the CFO at Netflix, they're going to take his call because they want investors to invest in their company because they want the price of that company's stock to go up. So they're going to cater to institutional money managers. And so a mutual fund is a situation where you're pooling your money together and hiring a team of money managers to make the decisions about what stocks to buy and what to sell and when to sell them. So that's a mutual fund. A mutual fund is an open-ended investment. So there's no limit to the number of shares a mutual fund can have. When you add money to a mutual fund, you're increasing the number of shares that are available. The disadvantage to a mutual fund is that it's priced one time a day, and that's at the market's close. When the market closes, they take the closing market value of all the stocks in the portfolio and divide it by the total number of shares, and that's the share price. A few years ago, they came out with a new vehicle called an ETF, an exchange traded fund. Unlike a mutual fund that's open-ended and there are more shares available all the time, an exchange traded fund has a limited number of shares available for trading. And it trades like a stock throughout the day on the exchange. So, for example, I'm going to bring up a mutual fund. If I can remember the symbol. Helps if you can spell. I know I didn't want comic books. All right. Here's a mutual fund that started trading in 1931, Investment Company of America. Current share price is $57 a share. This is one that's only priced once a day after the market is closed. If you own shares of this fund, here are the top holdings. These are the sectors. The top sector is technology with about 17, almost 18% of the portfolio. Healthcare makes up about 12%, and financial services about 10%. The top 10 holdings of this fund currently are Microsoft, Facebook, Comcast, Broadcom, Amazon, etc. So these are the top 10. These top 10 holdings make up 38% of the total assets. So if you buy this mutual fund, you're a part owner of all of these companies. So you actually own shares indirectly of these companies that are listed. The performance on this fund, the last 10 years, it's averaged 10.2%. And that takes into account the recent decline that we've just gone through. The 5-year average is about just shy of 10%. So this is a mutual fund. I'm going to bring up an exchange traded fund now, QQQ. This is the Invesco QQQ. It's $269 a share. This trades throughout the day, just like if you were buying Microsoft stock or Netflix or any other company. And the top holdings look very similar. Apple, Microsoft, Amazon. This is going to be very tech heavy. Tech is going to make up 46, almost 47% of the portfolio. And return wise, over the last 10 years, this has averaged 15.7%. So how many doublings would that have given you? Remember the rule of 72. Divide the rate of return into 72, and that'll tell you how long it takes the money to double.
What's the rate of return?
About 4.5 years. So you'd get 2 doublings in a 10-year period out of this. But it's volatile. Look at this chart. Let's go back 5 years. See, this was in November of last year. That was when we peaked. And from peak to trough, we're down 40%. That can be very uncomfortable. But if you're young and you're investing on a regular basis, like through your 401k, or if it's a non-retirement account and you're just trying to build up some between here and retirement money, this is exactly the time to be adding money to your investments while things are on sale. My experience in dealing with people, when the market is at an all-time high, like it was up here, and we were up for the year 30, 35%, people were rushing in to add money to their accounts. They're getting their statements now and seeing that they're down 30, 35%. They're afraid and they want to pull money out. This is the time to add to it, not take money away. Buying shares while they're on sale. But it's the stock market's the only place where when things go on sale, people want to buy less. If green beans are on sale, you load up on them when they're on sale. Even if you don't like green beans, you buy them. But this is the time to be adding to your investment portfolio if you have a long-term time horizon, because it may take us 3 to 5 years to get out of this hole that we've slipped into. It could take a while, but you can see how volatile this investment is compared to the mutual fund Now, this is an exchange traded fund, so it's different than a mutual fund. All right, let's look at this chart over a 10-year period. And see, it looks fairly similar, this drop off over the last year. So an exchange traded fund is also a pooled investment where you're pooling your money together with other people and that have the same investment objective. And professional money managers are making the decision about which stocks to put in the portfolio and which ones to avoid. The difference is you can get in and out of an exchange traded fund anytime during the day that the market is open, and a mutual fund just at the close of the market, okay, after the market is closed. So these are two examples where you're hiring professional managers to do the research and make the decision about what stocks to own. Something that's become really popular are index funds. An index fund is an unmanaged basket of stocks. There's nobody making a decision about whether Microsoft looks good right now or not. If it's part of the index, you own it. So like the S&P 500 is 500 companies that cover 10 different market sectors, and an exchange traded fund or an index fund is going to own all 500 of those stocks. No matter how horribly one of them may be doing, it's still going to be in the portfolio. But you've got 500 stocks. Why do you think somebody would want an unmanaged fund as opposed to professional money managers making the decisions about which companies to include in the portfolio? That's right, the fees. An index fund has much lower fees because those brainy people want to get paid, the ones who are making the decisions about stocks to put in the portfolio. And there's a debate in the industry about which makes more sense, buying an index or buying a managed fund. Over time, the index has outperformed managed funds. But the one thing that the index can't do is go to cash, get out of the market, where a mutual fund can get out of the market and avoid some of the downside. So the difference can be how much downside there can be. If you own an index fund, you're going to participate in all of the downside, and you're going to participate in all of the upside. But with a managed fund, you're going to get most of the upside and most of the downside, but not all. So the ride's going to be a little bit smoother. So there are a lot of examples of different indexes. There are international indexes, the EAFE, and I can't remember what EAFE stands for, EAFE. There are index funds that are just technology based. There are index funds that are internationally based. So one thing Wall Street is very good at, it's creating product to sell. And there are tens of thousands of mutual funds. So you can pick any flavor you want, and they're all going to claim they're better than their competitor. But the biggest mistake you can make is not picking the wrong fund. It's not investing at all. That's the biggest mistake you can make. So you may not be in the perfect fund or the one that goes up the most, but not investing is the biggest risk. So does that clear up the difference between an index fund and an exchange traded fund and a mutual fund? I know it's a lot.
I'm glad you mentioned them, because I was trying to remember when you're talking about the IRAs, like what my life insurance uses, and I'm pretty sure she uses an index fund in regards to how that invests.
Yeah, because what you're building up in that life insurance policy is a cash reserve. And that cash reserve is invested in a variety of different things, but at your age, it should be mostly invested in the stock market, in stock funds inside the insurance policy.
What about scalping?
Scalping. Well, my first thought with scalping would be like if you had tickets to the Kansas City Chiefs game last Sunday and you paid $100 for them, and you're standing out in front of the stadium offering to sell them to somebody for $200. The old capitalism, free enterprise. You've taken a risk and you bought $100 ticket. You're hoping to sell it for more than the $100 you paid for it. Once the game starts and the value starts to go down, when the game is over, if you haven't sold the ticket, you've got a ticket. Suitable for framing, but it's of no value. That's what I think of with scalping. Do you have another example of scalping in mind?
I know, like some of my friends that investing, they like, it's very, you have to stay on the market and then you have to wait on that right like road or that spike to like, you know, sell it back or buy like when it's low to buy it. So like they have to stay on the computer like a lot. But
Yeah.
I was just curious how fast, like how much of money you potentially get within that like few minutes or.
Yeah, I refer to that as day trading, where you're in and out of the market in a short period of time. For most people, it's extremely risky because, and you have to make it work, you have to have a ton of money. Because stocks typically don't change more than 1 or 2% a day. Today was unusual. We had about a 4% increase in the market in one day. So to make day trading worthwhile, you have to have a lot of money to be able to buy a lot of shares. So if it goes up a quarter and you own 1,000 shares of something, you're making a decent profit. But if you're trying to day trade on a couple of $100, you're not being paid very well for your time. And it's pretty risky stuff. And I come from the background of the buy and hold strategy. You buy good stuff and you hang on to it over time. People that bought Walmart stock 40 years ago, well, I had clients that were cashiers at Walmart back when Walmart was first getting going, and Sam Walton would give employees shares of stock as a bonus. And these people may have made $3 or $4 an hour in their working lifetime, maybe 5, but they retired as millionaires because the Walmart stock had done so well over time. Now, Walmart's not growing like that today, but there are other companies that are new, that are still in their growth stages. So, yeah, you don't have to be rich to get rich, but you have to have patience and time. Other questions? I don't know how long you wanted me to go on, but
We have time for 1 or 2 more. If anybody has any.
there's no silly question. I see a question in your eyes.
Yeah, so I'm trying to think, so I know that I wouldn't have the time or even just like the awareness to watch the market myself. And so I'm trying to think like how much money would be smart to try to save and hold on to before I would go to somebody else to do that. Because I would also have to think about how much I'm paying them to do that also.
Most investment professionals today operate on a fee basis, not a commission basis. So we get compensated based on the assets that we manage. So I didn't want you to think if I called you and said, hey, I think this is a great time to buy
General Motors stock. That I was making that recommendation because I wanted to generate a commission to get paid. I charged 1% for the assets that we manage. And so my goal was the same as yours. If your investment grows, my income grows. So we're on the same side of the desk, and it's not confrontational. I'm not selling you anything. I'm trying to help you get from point A to point B.
I wish these worked. I'll just explain it. Think of a pyramid. Everybody familiar with Maslow's hierarchy of needs? Somehow they managed to get that in every single college class I ever took. You know, if it was a geology class, somehow Maslow's hierarchy made it in there. Well, the base of that pyramid is just like Maslow, but in the financial world, it's, and I haven't drawn this pyramid in a long time, I'm drawing a blank. It's the foundation, the basis. Things like cash reserves, number one. That's the foundation, cash reserves. You've got to have a rainy day fund. You can't put it in the market because it might go down 25%. So you need that to be safe, available, and earning some kind of return if possible, but mostly it's there for emergencies. Okay. Above that is safety needs, and you touched on that, and that's your insurance. Having it doesn't do me a lot of good to help somebody amass wealth if they have a financial catastrophe and it wipes them out. So you've got to have health insurance. The reason to have life insurance is so you don't leave somebody in a financial bind. So if you've got any debt or things like that, you need life insurance to cover that. How much life insurance? Well, the joke is enough that people come to the funeral, but not so much that they're smiling. Okay. Then the next step above that would be what I refer to as between here and retirement money. This is money for a house in 10 years. This is money for a vacation to Hawaii. This is money for stuff you want to do before retirement. Maybe a kid's college fund. Maybe your parents had college funds for you. Then the next step above that would be retirement assets. This is stuff that is out of reach for the next 40 years. You're not going to touch it. Once you've got all of those pieces in place in the pyramid, then you can afford to speculate. Then you can afford to buy lottery tickets. Okay. Until you get all this other stuff in place, you can't afford to buy lottery tickets. Okay. I know somebody wins, but it's not going to be you. Okay. Does that kind of help put it in order of how things should progress? Other questions?
So with that, is there like anything that you've noticed is like an average starting investment point?
Dollar wise?
Good, I figured that probably be individual cases.
The first thing to do is get a safety net or a savings account with several $100s in it, enough to cover deductible on your car insurance and a rainy day fund of some kind.
That's just with your bank.
Yeah. Mm-hmm. Yeah. That's the best place, and not in your checking account because it's too easy for it to evaporate.
Yeah.
Money evaporates. And so in a savings account or something to the side. And then when you get that rainy day fund built up, then start out with if it's a company plan, participate in the 401k or 403b, because you won't miss that. If it never gets in your checking account, you'll never miss it. Okay. But once it gets in your checking account, what's going to happen to it? It's going to evaporate. So treat savings like it's a bill. Treat savings like it's a bill. If you have a bill, if you get a bill from the phone company, you're gonna pay it. If you get a bill from the electric company, you're gonna pay it. So you need to put yourself down as a bill that you have to pay every single month. And you will. But if you wait and say, okay, if I have any money left over, I'll save it, never happens. Because you're gonna spend whatever you make. That's a rule. I didn't write the rules, but those are the rules. What have I forgotten? Yes, yes,
Are you gonna teach the class next semester?
I am not. What am I forgetting to tell them, Georgia?
Yeah,
What?
mainly,
Yeah, Georgia.
mainly just paying yourself first. That's definitely what I didn't realize. Like if you treat it like you said, like a bill, that's something I never thought of until I took this class.
Yeah, yeah. So big things are rule of 72. So you know how long it's going to take your money to double. If you're earning 1% on your money, how long is it going to take to double? 72 years. A long time. So you can't just put it in a coffee can and bury it in the backyard, because you'll forget where the coffee can is, and or the dog will dig it up and take it over to the neighbors. Something will happen.
Inflation will cut it.
And inflation will kill it. That's right. Yeah, I had an idea years ago. You know, the coffee cans that everybody gets, they're plastic now, which is even better for my plan. But you've seen these infomercials on TV late at night where they're trying to sell you some junky idea, but people buy them apparently. Well, I was going to sell a savings kit, and it was going to be 3 coffee cans, an army backpack shovel, and some surveyor flags. So when you buried the can in the backyard, you could put the flag there so you know where to go dig it back up. Oh, absolutely. And now we've got the GPS modules. So I include those instead of the surveyor flag to find your can again. But yeah, 1995, 3 coffee cans and a shovel, and take this idea for your senior project.
Capstone.
That's your capstone project, and run with it, and just give me credit somewhere in the, yeah, you don't have to give me any financial credit, just recognize that where the idea came from.
Thank you so much.
You're welcome. My goal is the Hippocratic Oath, and that's do no harm. So hopefully I did no harm. Good luck with your school year.
Hey, Jordan,
Yeah.
how many articles we're supposed to have for Tuesday?
I did 3. You did 3? Okay. I'm just gonna swim 3 because you didn't say.
Okay, thanks. Bye, guys.
Thank you so much.
You're welcome. Bye-bye.
Do you have a link and I can connect with you?
Yeah.
I love you.